Hey, I just want to give you a quick update on what's going on in the market and the economy right now. A couple of weeks ago, Ben Bernanke and the Fed announced that they were going to possibly stop the quantitative easing program where they are buying $85 billion a month in U.S. Treasuries. Of course, this is a stock market that's been addicted to stimulus. I've been writing about that in my newsletters, and make sure you read the newsletters each and every week. As you know, I write them personally. They're all free on the website. But this market has been addicted to stimulus, like the quantitative easing and the stimulus or not. Regardless, this market has been using it as a way to go higher. The Fed has enjoyed this because they're looking for the wealth effect, meaning everybody's making money in their 401ks or in their stock portfolios. People feel wealthier, and therefore they spend money, and they look for the trickle-down effect. Whether it's having a positive, true effect on the economy, we won't know for several years. A lot of people don't think it is. Some people think it is doing that. Regardless, if the Fed does stop stimulating and cuts off the purchase of bonds, the stock market is probably in a precarious situation, and I wouldn't want to be in stocks. However, I don't think that's happening. I don't think that the Fed is about to shut it off or even really wane it down. We're seeing a lot of information, a lot of statistics come out that are showing that the economy is actually slowing. We had taxes increase at the end of last year. We had a lot of government spending through the sequester take effect. Just a couple of days ago, we saw the ISM manufacturing numbers come in much lower than expected. Unemployment is not going down. So although the Fed said that they may want to stop with the stimulus, I think it was just more of a warning so that at some point they want us to be aware that they will. I don't think they will because there's one other factor, and that's inflation. Inflation is coming in at about 0.7% annually. The Fed wants to say 2%. Now, of course, you and I both know that if you eat, drive, turn on the heat, buy milk, it's much higher, closer to 4 or 5%. But the Fed is looking for their own numbers. And if inflation is too low, that means we have deflation in the economy. Deflation, unfortunately, is enemy number one for any capitalist society. Japan has seen deflation for the last 20, 25 years. Now they're trying to inflate their way out to create some inflation. And if we have too low inflation, negative inflation, or what's called deflation, then I think the Fed will fight that as well and stimulate possibly even more. So although they think they're probably giving us a hint of that they would like to stop the purchases, I don't see that happening anytime soon. The market's in a little bit of a flux right now. We're in between earnings season, or what I call the earnings nap period, where there's no earnings to rely on. So everyone's hinging on what the Fed and what Bernanke says. So we're having much more volatility than we've seen in the last 4, 6, even 8 months. So a lot of bouncing around. We are due for a correction. Every time we seem to get that 3, 4, 5, 6% correction that everyone says we need, as soon as we're down 3 or 4%, everyone panics and goes, oh my God, is the world coming to an end? I don't think so. I think this is just a normal correction, normal period. The Fed will probably announce that they're going to continue stimulating to some effect, which will help stocks over the long term. So I think we're okay here. This is not a time to panic. Markets are going to bounce around a lot. Try not to let it bother you. Try not to let it affect you too much. I'm watching it every day, every minute, every hour. But at this point, you just don't want to react or overreact to the market.